housing market is about to get interesting. Right now we're experiencing some interesting times between the housing supply being at the all-time record low that we've ever seen, interest rates are up over 1% in the last year alone, and inflation is at the highest levels we've seen in over 40 years. Couple that with tremendous wage growth, an ongoing stock market crash, and a war between Russia and Ukraine, and there are a lot of conflicting dynamics at play. Some that have a positive effect for the housing market, and others that have a negative effect. So today we're going to take a look at what's going on in today's housing market, along with where things are really starting to go. But before I get started, do me a favor, support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. The biggest change we've seen recently in real estate is mortgage interest rates going up, and that is also the biggest thing that can continue to change the dynamic of the housing market. You see, in just the last year alone, we've seen over a 1% increase, which changes drastically the monthly payment you have to make. You see, for instance, if you had a $400,000 loan at a 2.65% rate, which is where it was back in January of 2021, you'd be looking at a $1,612 monthly payment. Whereas if you take that same loan and you put it at a 3.76% rate, which is roughly where it's at about right now, you'd be looking at a $1,855 a month payment, which is almost $250 a month difference. Now that's obviously enough to feel a difference in your monthly payment, but it's not enough to completely slow down and cause a housing crash. The reality is there is a massive amount of demand right now for housing, the likes of which we haven't seen in a long time, and because of that, it's going to take a lot more than simply 1% increase in mortgage rates in order to completely change the direction of the housing market. Now, many of you know that over the past months and years, the Fed has been buying billions of dollars of treasury bonds and mortgage-backed securities, artificially driving down these mortgage interest rates to these record lows that we've never seen before. Well, that is finally coming to an end. They are stopping their quantitative easing as of this month, and that will have a huge impact on interest rates, which is why many people have been anticipating for ages that interest rates will start to go up again. Now, over the past years, really dating all the way back to the Great Recession of 2008, the Federal Reserve has been building up their balance sheet to a total of over $9 trillion. And so they're at a point where they need to start reducing their balance sheet. This is what's known as quantitative tightening. Now, quantitative tightening is just simply the opposite of quantitative easing, and without getting too technical, quantitative easing is when the government is injecting money into the market, buying bonds, buying financial assets in order to drive down interest rates, which driving down interest rates helps spur economic activity. You're going to have more people borrowing money, you're going to have more people spending money, and so overall it helps the overall economy. Now, quantitative tightening is the complete opposite of that, and the reason why you would want to raise interest rates, if you're wondering, is because we have this high inflation, and one of the best ways to fight inflation is through raising interest rates. And so this is why, as the Federal Reserve stops their quantitative easing, stops buying these mortgage-backed securities and treasury bonds, and starts to reduce their balance sheet, people are expecting, and many experts are expecting, for interest rates to continue rising, which if they continue to rise, eventually it will become a problem for the housing market because affordability then becomes the main issue. So at the end of the day, they may say they're going to do this, they may say they're going to reduce their balance sheet and stop quantitative easing, but until we see them actually do it, we can't fully take them at their word, because there's been many times in the past when they've said they're going to do something and then their actions speak differently than their words. Not to mention that things can drastically change with this Russia-Ukraine crisis. So although there is a very realistic possibility that interest rates do continue to rise, we just don't know, and we have to continue to monitor what they actually end up doing versus what they say they're going to do. Now, as for now and what we know this moment, I truly do believe that house prices are going to be continuing to go up. Housing inventory is at an all-time record low right now, with only 860,000 houses available nationwide as of January 2022. Now, if you're wondering how this compares to last year, last January 2021, there was 1,030,000 houses, and that was already a crazy market to begin with. So putting that down to 860,000 houses, we're really likely to see house prices continue to climb. In addition to that, as of January 2022, unsold inventory currently sits at 1.6 months inventory, which compared to December at 1.7 months months inventory, and January of 2021, a year ago, when he was at 1.9 months of inventory, it just keeps getting smaller and smaller. Wages are another important thing we really need to keep an eye on, because as wages continue to grow, it increases the amount of money that people can borrow and afford to pay for on a mortgage payment. So with that said, wage growth is up over 4.5% in the last year alone, according to the latest reports in December 2021. And with that said, it's the highest rate of increase we've seen for wages since 1983. So this is tremendous wage growth we're seeing right now, and many experts expect that we're going to continue to see records broken as far as wage growth is concerned in the year 2022. So you're starting to see why I believe that house prices are going to continue to rise between wages going up. You got the low housing supply. Let's talk about demand right now. Right now, we're experiencing record-breaking demand in real estate. And let me tell you why. First of all, you have millennials reaching their peak home buying years, wanting to buy a home for their family to live in. Secondly, you have many investors that are starting to cash out of stocks as the stock market crash is taking place, and they want to park their money in a hedge against inflation, and real estate is seen as a great hedge against inflation. And so we're seeing a lot of investors putting their money and parking it in real estate. We're also seeing more and more institutional investors targeting these single-family build-for-rent homes, where you have developers building entire single-family communities, and then they sell it off to an investor who buys the whole entire development and then rents out the houses to different people. Now, looking at real estate investors as a whole, we're seeing record-breaking demand. You see, Redfin reported that as of quarter 4 for 2021, we saw 18.4% of all home buyers nationwide were investors. So that means that almost 1 out of every 5 home buyers was an investor. And in some areas like Atlanta and Charlotte, North Carolina, you're seeing almost 1 out of every 3 home buyers being an investor. So there's a couple of things we need to consider here. For one, Redfin reported that over 75% of all the investor purchases were done with cash. And this is a really big deal, because if interest rates are one of our biggest concerns, them going up, making mortgage payments more expensive, well, if you're buying in cash, then that's going to be much less of a concern for you. Secondly, investors don't have to worry as much about mortgage rates as a regular home buyer does. And the reason is ultimately what investors care about is their yield or their cash flow. As long as the property cash flows enough to what they want, then they're going to buy the property at the end of the day. So where are these potential home buyers going to go if they can't afford a home anymore because of mortgage rates going up? Well, they're going to start to look to rent a house, which means if you have more people looking to rent a house now than there was before, that's more upward pressure going on rents, which means if you could get a higher amount of rent, you can stomach the higher interest rate as an investor. So basically what I'm saying is investors are not likely to stop buying homes due to interest rates going up, because as long as they can get the cash flow they're looking for, they're going to continue to buy houses. So this is why, between the low housing supply, between the crazy record-breaking demand that we're seeing, between investors taking part like we've never seen before, between wages rising the way we haven't seen since 1983, that I truly believe that we're going to continue to see home prices rise over this next year. It's also important to note that for those who believe a crash is on the horizon, the housing market crashes take a long time to take place. It doesn't happen in an instant like the stock market or in cryptocurrency. It takes a long time to build up supply, because that's what you really need to see, is you need to see an abundance of supply on the market to where it's starting to see prices drop down. Whereas right now we are at the record all-time low in housing supply. So we have to go from that point all the way to the point where we have an abundance of supply, and that is not going to happen in 1 month, in 3 months, or even in 6 months. It's going to take a while for that to take place, and we haven't even begun to see the beginning stages of that yet. So that's why I truly believe that house prices are going to continue to go up for now. And unless we see interest rates take a significant jump up to somewhere like 6% out of nowhere, that would definitely be the exception to the rule. But based on what the Federal Reserve has done so far, they've proven to be very protective of any kind of market crash happening. So I don't believe they're going to do anything to put us in that kind of position. So overall, the housing market continues to be in strong form. Even with rising interest rates, we continue to see record-breaking low supply, record-breaking demand, and people just continue to buy houses as it's still affordable for the time being. And so for that reason, I continue to see house prices going up over this next year, and who knows what happens from there. But for now, this is the latest that's going on with the housing market. And if you guys enjoyed this video, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch watch more content like this. Also, let me know in the comments below, what do you think about today's housing market? Finally, follow me on TikTok and Instagram at The Out of State Investor. Thanks again for watching, and I'll see you on the next one.